Last two videos we talked about regime, the overall state of the tape, and the risk gauge, the six-signal composite ArcAlpha uses to read it. But there's one more piece. Some days of the year move markets more than others, and it's not random. You can see them on a calendar a month out. Four categories cover almost all of them: Fed days, jobs reports, inflation reports, earnings season. This video covers each: what happens, why it moves markets, and how traders treat these days differently from normal trading days. First and biggest, Fed days. The FOMC, the Federal Open Market Committee, meets 8 times a year on a published calendar to decide what to do with interest rates. 3 pieces come out of each meeting: the rate decision itself, a statement explaining the reasoning, and 4 meetings per year, a dot plot showing where each committee member expects rates to go over the next few years. Then, half an hour after the release, the Fed chair holds a press conference, taking questions, giving context. That press conference can move markets more than the release itself because tone matters and markets listen for it. Fed days matter because rates are the denominator of nearly every asset price. If rates move, stock valuations move. If rate expectations move, stock prices move. A Fed day can reset the entire regime in an afternoon. Volatility is known to expand on Fed days. The options market prices it in ahead of time. Most of the expansion happens between the release 2 p.m. Eastern and the end of the press conference about 90 minutes later. Traders typically treat Fed afternoons as their own regime. Positions entered before 2 p.m. often get re-evaluated, and some are closed preemptively. New entries are generally deferred until after the press conference ends, when the reaction has played out and the tape has a new direction. Second category, jobs reports. The monthly headline comes from the Bureau of Labor Statistics, the Non-Farm Payrolls Report, abbreviated NFP. First Friday of every month at 8:30 a.m. Eastern. NFP shows how many jobs the economy added or lost in the previous month, plus unemployment rate and average hourly earnings, the 3 numbers that matter most. Jobs matter because they're half of the Fed's dual mandate maximum employment. A strong jobs report signals the economy is running hot. A weak one signals cooling. Either way, rate expectations shift. The market reaction happens in the first few minutes after 8:30. By the time the regular session opens at 9:30, most of the move is done, but the day's direction is usually set by the reaction. Traders who carry positions through NFP typically know they are accepting a volatility event. Many scale down or close before. Others, particularly intraday traders, use the first hour after the open to read the reaction and position for the follow-through. Third category, inflation reports. Headline is the CPI, Consumer Price Index, monthly, 8:30 a.m. Eastern, usually mid-month. CPI shows how much prices changed month over month and year over year. 2 numbers, headline CPI and core CPI, which excludes food and energy. Core is what the Fed watches more closely because it's less volatile. Inflation is the other half of the Fed's mandate, price stability. When CPI surprises the market, hotter than expected or cooler, rate expectations reset immediately. That reset propagates across every asset class in minutes. Volatility on CPI days rivals Fed days. The reaction is concentrated in the first 15 minutes after release. Indices can move more than a full % before the regular session even opens. Like NFP, traders who hold through CPI are accepting the volatility explicitly. Many reduce size, tighten stops, or close entirely before release. The day's trading plan is built around the reaction, not around normal chart setups. Fourth category, earnings. Not one day, a whole season. 4 seasons per year, each lasting about 6 weeks, starting shortly after each calendar quarter ends. Earnings season is different from the macro events because it's name-specific. A Fed day moves the whole market. An earnings release moves one stock. Hard, usually 20 to 30% of names report on any given week during the peak. Before a company reports, volatility in its options tends to rise. The market is pricing in the unknown. Setups in a stock into earnings are different trades than setups in a stock right after. One has a binary event ahead, the other has clarity. After the release, the stock typically gaps, opens at a very different price than it closed. Traders who held through earnings accepted that gap risk. Traders who exited before didn't. Individual names dominate the headlines during earnings season, but the indices also move on aggregated results. When enough big-cap names beat or miss, the whole tape shifts. Earnings season often coincides with the clearest regime changes of the year. So 4 categories: Fed days, jobs, inflation, earnings, all scheduled, all on your calendar months in advance. None surprises you if you're paying attention. That gives you two types of reads on the tape. The risk gauge, the composite from 202, tells you what the market is doing now, moment to moment. The calendar tells you what days will be different on a schedule. The markets page surfaces upcoming scheduled events alongside the indicators, so a trader scanning for setups in the morning can see at a glance whether today is a normal day or an event day. The platform surfaces the schedule. You decide how to trade around it. The discipline, traders who know the calendar don't get surprised by it. They don't close every position every time, but they size and stop differently when an event is looming. Knowing the calendar is knowing when the noise floor rises. So that's track 2, regime as the backdrop, the risk gauge as the composite read on risk appetite, and the calendar, 4 categories of scheduled events that reliably change how the tape behaves on specific days. Regime, indicators, calendar, 3 layers of market intelligence. Together they give you the environment your setups are trading inside. Every later track in the catalog assumes you can read this environment. The chart work you learn in technical analysis, the risk framing you learn in risk management, the smart money reads you learn in ArcFlow, all sit on top of the market intelligence layer you've now built. This is educational content and is not a recommendation to buy or sell any security.